High inflation and recession at the same time. Last time this happened was the 1970s, and it destroyed the middle class. The 1% made fortunes. Their exact playbook for 2026 is here. Welcome back to Wealth Architect. I'm Dr. Ben. You've been told to save 10%, buy index funds, and wait 40 years for freedom. That's not a plan, it's a slow trap. Today, we're breaking down the economic storm headed our way in 2026 and showing you exactly how the top 1% are already turning it into their biggest payday ever. We're going step by step through what this actually looks like, how they won last time, the exact moves they're making right now, and the complete blueprint you can start using to protect and grow what you have. This one episode could save you years of lost progress. Grab a notebook, because the steps I'm sharing are the ones the wealthy use quietly, while everyone else follows the old rules. Let's get into it. What stagflation actually looks like and the warning signs already flashing for 2026. Picture this. Your grocery bill jumps 30% in a year, gas prices double, rent keeps climbing, but your paycheck stays exactly the same, and job openings start drying up. That's stagflation. It's not regular inflation, where everything rises but the economy grows with it, and it's not a normal recession where prices fall and you can wait it out. It's both happening together, prices up, growth down, and your money losing buying power fast. In the 1970s, we lived through it for nearly a decade. Inflation averaged more than 7% a year and hit peaks above 13%. Unemployment climbed past 9%. The stock market, once you adjust for those rising prices, dropped almost 50% between 1973 and 1974. Families lined up for gas, cut meat from the dinner table, and watched their savings accounts shrink in real terms every single month. Homes that were supposed to build wealth became expensive to heat and maintain, while wages barely moved. Right now, in early 2026, the same ingredients are lining up again. Government debt is at record levels, supply chains are still feeling shocks from recent global events, and central banks are trying to fight inflation without killing growth. Commodity prices for food and energy are showing volatility. Unemployment is ticking up in certain sectors, and GDP growth is flattening. Economists tracking these patterns are warning that the mix could hit hard this year and next. Here are the 5 clear signals to watch every month so you're never caught off guard. CPI for food, fuel, and housing rising faster than overall inflation. Unemployment increasing while average wages stay flat or fall behind. Oil and key metals jumping 20% or more in short periods. Long-term bond prices falling even as the Fed holds rates steady. Business investments slowing while consumer prices keep climbing. When 3 or more of these line up, you know stagflation is here. The good news? Spotting them early gives you time to move. Most people wait until the headlines scream crisis, and then it's too late. You're not most people. You're here to build the blueprint. The 1970s playbook that turned the nightmare into fortunes for the 1%. While regular families were cutting back, a small group built serious wealth. Let's look at exactly how they did it, because the pattern is repeatable. First, energy and oil. When the OPEC embargo hit, crude prices quadrupled. Companies like Exxon and Mobil reported earnings jumps of hundreds of percent in a single year. Investors who owned shares or direct interests in energy saw their holdings explode. They didn't predict the future. They owned the assets people still needed no matter what. Second, gold and precious metals. Before 1971, gold was stuck at $35 an ounce under the old dollar standard. When that ended, the price raced past $800. People who bought physical gold bars, coins, or mining stocks protected their purchasing power and turned it into multiples. One well-known group, the Hunt brothers, took silver even higher and made legendary gains. Third, real estate with smart debt. Investors who locked in low fixed-rate mortgages before the spike watched inflation make their debt cheaper every year while property values rose. They raised rents to match rising costs and kept strong cash flow. The debt became a tool instead of a burden. Fourth, business owners in essentials. Companies selling food, medicine, utilities, or basic materials simply passed higher costs to customers who had no choice but to pay. Their margins stayed healthy because demand didn't disappear, it just cost more. The common thread? They owned real things that hold or increase value when paper money loses it. They used debt before rates went crazy. They focused on assets people always need, and they stayed calm while everyone else panicked. That same calm approach is exactly what the wealthy are repeating right now with 2026 updates. The 2026 version of their moves, exactly what the 1% are doing quietly today. The world has new tools, but the principles are the same. Here are the 8 specific shifts happening in private circles right now. Broader commodity exposure, not just oil, but copper for electrification, grains for food security, and industrial metals that rise with tight supply. Real estate with fixed financing on income properties that can adjust rents upward. Ownership in private companies or essential services where pricing power stays strong. Global diversification to places with different cycles so one slowdown doesn't hit everything. Modern vehicles like targeted ETFs and funds that give clean exposure without direct ownership hassles. Farmland and timber assets that produce actual yields while the land itself gains with inflation. Selective use of borrowing at current rates before they potentially rise further. Building or expanding personal cash flow projects where you control the price. These aren't random bets, they're deliberate moves into assets that perform when traditional stocks and bonds struggle. The wealthy are already positioned through family offices and networks most people never see. The difference today is you can access versions of these same strategies through regular accounts if you know the exact names and steps. Your complete inflation-beating allocation blueprint you can start building this month. This is the practical mix the smart money uses, adjusted for today's markets. You don't need millions to start. You scale it to your situation and add pieces over time. Roughly 30% in gold and silver exposure. This can be physical coins or bars you hold yourself, or easy ETFs like those tracking the price directly, or even quality mining companies. Gold acted as the shield in the 1970s and still does when paper money weakens. 20% in energy and materials. Look at funds or companies focused on oil, natural gas, copper, and steel. When supply tightens and prices rise, these sectors move first. 25% in real estate you can control. This could be direct rental properties if you're ready, or focused REITs and trusts holding apartments, warehouses, or essential commercial space with leases that keep up with costs.
10 to 15% in your own business or side income streams. This is where you set the prices and keep the upside. Even a small service or product line that people still need gives you control. The rest in defensive stocks, utilities, infrastructure, and consumer staples that people buy no matter the economy. These hold steadier when everything else drops. How to build it step by step. Week 1, open or review your brokerage and retirement accounts. Week 2, start with the gold and silver piece using dollar cost averaging so you buy gradually. Month 2, add the energy allocation through low-cost funds. Month 3, research real estate options that fit your location and budget. Every quarter, check the numbers and rebalance only if one piece moves way out of line. Keep cash for emergencies, but minimize it because inflation eats it. Use tax-advantaged accounts where possible to keep more of what you make. This mix is designed to keep producing income and hold value even when the broader market stalls. Remember, this is for educational purposes only and not personalized advice. Talk with your own advisor and do your homework before moving money. The 5 costly mistakes that destroy most people in stagflation and how to avoid every one. Mistake 1. Keeping everything in cash or regular savings accounts. Inflation quietly steals 7 to 13% a year while you earn almost nothing. Fix: move only what you need for 3 to 6 months of expenses and put the rest to work in the blueprint above. Mistake 2. holding long-term bonds or bond-heavy portfolios. When rates rise or inflation sticks, their value drops hard. Fix, limit bonds to very short-term or inflation-protected types, if any. Mistake 3, chasing the stock market without protection. The 1970s showed stocks can lose half their real value. Fix, keep only the defensive slice and pair it with hard assets. Mistake 4, waiting for the perfect time or more information. Most people watch prices rise for months before acting. Fix, start small this month with one piece of the allocation and build from there. Mistake 5, ignoring your own income power, relying only on a salary that can't keep up. Fix, create or expand one side stream where you control pricing. Avoid these and you're already ahead of 95% of people. Real examples of architects who used this approach and built lasting wealth. Consider the families who bought farmland in the Midwest in the late 1960s. When food prices soared, they earned higher rents and the land itself tripled in value. Or the business owners who ran local distribution companies for fuel and groceries. They raised prices with the market and kept strong profits while big corporations struggled. Even regular professionals who quietly added gold and energy positions in the early 1970s turned modest savings into multiples by the end of the decade. Their secret wasn't luck or huge starting capital. It was following the same asset mix we just covered and staying consistent through the noise. You can do the same version today with the tools available now. Your exact 30-day action plan so you start protecting your wealth this week. Day 1 through 3, list every account you have and calculate your current mix. Day 4 through 7, research and open positions in the gold or silver piece. Even $500 to start builds the habit. Days 8 to 14, choose one energy or materials fund and add your next slice. Days 15 to 21, review real estate options in your area or through accessible funds. Days 22 to 30, set up automatic monthly contributions to each part of the blueprint and note the prices you paid so you can track over time. At the end of 30 days, you'll have the foundation in place and the confidence that comes from action instead of waiting. Every month after that, you simply add the next piece. How to monitor and adjust as 2026 unfolds. Check your allocation once per quarter. Look at the 5 warning signals we covered earlier. If inflation spikes higher than expected, increase the hard asset side slightly. If growth slows more than prices, lean a bit more into income-producing real estate. Never make big changes based on one headline. Use the same calm approach the 1% have always used. Track everything in a simple spreadsheet: asset, amount, purchase price, current value. This keeps you in control instead of reacting. That's the complete playbook the 1% have used for 50 years and are already wanting for 2026. You now have the exact steps to protect your money and turn this challenge into an advantage while others stay stuck in the old system. If this gave you clarity and a plan you can actually use, hit subscribe right now and turn on notifications so you never miss the next blueprint. Drop a comment below with which piece of the allocation you're starting first. I read every single one and it helps shape future episodes. Share this with one friend who's worried about what's coming, because the more of us who build real freedom, the stronger our community gets. Next time, we're unpacking another hidden strategy the wealthy use to create cash flow that lasts. Until then, keep designing your future. I'm Dr. Ben. See you in the next episode.